What is an annuity and how do annuities work? Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. The video discusses the meaning of annuity, types of annuities and the way annuities works. In this video, you will understand the meaning of annuity, the stages of an annuity contract, how annuities work, the features of annuities, the advantages of buying an annuity, the practical considerations on annuities, and the types of annuities. Now, let us start. What is an annuity? An annuity is an insurance product designed to provide consumers with guaranteed income for life. Specifically, an annuity contract is a legally binding, written agreement between you and the insurance company that issues the contract. This contract transfers your longevity risk, the risk of you outliving your savings, to the insurance company. In exchange, you pay premiums as outlined in the contract. Annuities are essentially insurance contracts. Annuities are usually expressed in terms of the annual amount payable. In practice, they can be payable monthly, quarterly, half-yearly or yearly. The annuitant will pay a set amount of money today, or over time, in exchange for a lump sum payment or stream of income in the future. Annuities are, therefore, insurance contracts that provide a fixed income stream for a person's lifetime or a specified period. An annuity can be purchased with a lump sum or a series of payments and start collecting annuity almost immediately or in the future. Annuities are often used to complement retirement funds. An annuity is a form of pension. This is because retired people can purchase an annuity to provide an income that is guaranteed to last for life. Annuities can be a great addition to retirement income plans, as they are one of the few investment solutions that can ensure a person does outlive his money. Stages of an annuity contract. There are two stages to any annuity contract. The first stage of an annuity contract is the accumulation stage, or the period where the annuitant saves and potentially grows his retirement funds and builds his annuity's cash value. The second stage of an annuity contract is the distribution stage, when the annuitant is ready to start collecting the annuity to create an income in retirement. The process of converting the annuity into regular payments for retirement is known as annuitization. The way the annuitant builds his retirement funds and cash value, accumulation, and then convert those funds into guaranteed income, distribution, will depend on the type of annuity purchases. Some annuity contract terms. Annuity buyers must understand annuity terms. Here are some annuity terms. Insurer, this means the life insurance office that issues the contract and collects premium payments, then pays an annuity to the payee based on the terms of the contract. Owner, this is the investor who purchases the contract and pays the premiums. There can be joint owners, and a trust or trustee can also own the contract. Annuitant, this means the person whose life the annuity policy is based upon receives the contract's benefits. It means the person or persons whose life expectancy is used to calculate the annuity payout from the contract at annuitization. There can be joint annuitants. Premium, the collective total of the initial payment, and any subsequent payments, made to purchase an annuity, excluding earned interest. Policy, this is the legally binding contract issued by the insurance company that defines the annuity's terms, conditions, and benefits. Payee or beneficiary, this means the person who receives the annuity payments at annuitization. It is the individual's or legal entity named to receive the benefits of an annuity policy upon the annuitant's death, typically the spouse or the children. Annuitant, beneficiary, and payee are often the same persons. Accumulated period, this is the period of time that the annuity is intended to accumulate. Additional premium payments may be made during this time, depending on the terms of the annuity contract. Accumulated interest, this is the interest earnings accumulated inside an annuity contract that has not been withdrawn. Annuity payout period. This is the period within which the payee receives a payout from the contract at annuitization. Principal, the collective total of the initial premium deposit, and any subsequent premium deposits, paid to purchase an annuity, excluding earned interest. Annuitization, this means a one-time, irrevocable event at the end of the accumulation period when the accumulation units are converted into annuity units. This event will permanently convert the annuity contract into a guaranteed stream of income payments. Maturity date, the date specified within an annuity contract, at which time the owner must elect a settlement option and begin receiving payments by way of annuitizing the contract. Straight life payout, this is a form of annuity payout that ends when the annuitant dies. If the payee has not been paid an amount that equals the original principal that was invested, then the insurance carrier keeps the difference. Annuitization is required to receive this kind of payout. Joint life payout, this is a payout calculated based on a couple's life expectancies. Some payouts end with the death of the first person, and others end with the death of the second. Annuitization is required to receive this kind of payout. Period certain, this is a payout of at least a certain number of payments that will be made to either the primary or contingent payee. For example, if the payee opts to receive 20 years certain annuity and then dies 10 years later, the contingent payee will receive the remaining 10 years of payments. Period certain payouts are often combined with straight or joint life payouts to ensure that at least a certain number of payments will be made. Systematic withdrawal, this is a form of payout from the annuity contract where the owner receives a set amount each month from the contract without annuitization. There is no guaranteed lifetime income protection with this option. If the beneficiary exhausts all of the principal and growth from the contract, then payments will stop. Income benefit rider, this rider can be purchased under an annuity contract that will guarantee a minimum annual withdrawal amount. Annuitization is not required to exercise this benefit. Death benefit, this means the benefit is paid to the designated beneficiary or beneficiaries when the annuitant dies before annuitization. How do annuities work? Many retirees need more than Social Security and investment savings to provide for their daily needs. Annuities are designed to provide this income through a process of accumulation and annuitization or, in the case of immediate annuities, lifetime payments guaranteed by the insurance company that begin within a month of purchase. No accumulation phase is necessary. Annuities work by converting a lump sum premium into a stream of income that a person cannot outlive. In essence, when you buy a deferred annuity, you pay a premium to the insurance company. That initial investment will grow tax-deferred throughout the accumulation phase, typically anywhere from 10 to 30 years, based on the terms of your contract. Once the annuitization or distribution phase begins based on the terms of your contract, you will start receiving regular payments. Annuity contracts transfer all the risk of a down market to the insurance company. This means you, the annuity owner, are protected from market risk and longevity risk, that is, the risk of outliving your money. Insurance companies charge fees for investment management, contract riders, and other administrative services to offset this risk. In addition, most annuity contracts include surrender periods during which the contract holder cannot withdraw money from the annuity without incurring a surrender charge. Features of annuities. Furthermore, insurance companies generally impose caps, spreads, and participation rates on indexed annuities, each of which can reduce the return. Features of annuities include free look period, riders, beneficiaries, fees and commissions, and taxation. Free look period. Most states/countries require insurance companies to include a free look period that allows a buyer to cancel the contract without incurring a surrender charge. Riders. Riders are addendums that allow the customization of basic annuity contracts. The annuitant should understand the selected riders and their additional premiums. Beneficiaries. The annuitant can add a death benefit rider to the annuity contract to ensure that his beneficiary receives a portion of the contract value. Fees and commissions. The fees and commissions for annuities vary by the type of annuity. Fixed annuities generally have the lowest fees. Taxation. One of the most attractive features of annuities is their favorable tax treatment from tax authorities. For instance, if a person purchased an annuity with money that has already been taxed, only the annuity earnings will be taxed when the money is withdrawn. Advantages of buying an annuity. Buying an annuity can provide peace of mind by way of an additional retirement income. An annuity can provide a stream of income, in addition to pension and social security benefits, at retirement. Suppose the annuitant choose an annuity that provides payments for the remainder of his life. In that case, he might not need to worry about income after retirement, as long as the annuity can cover basic expenses. These guarantees can add some certainty to how much money the annuitant needs to save to retire comfortably. Annuities can be complicated, though, and they may not be for everyone or every situation. Practical considerations on annuities. An annuity is not the answer for everyone. First, the annuity payments depend on the insurance company's ability to make the annuity payments. Suppose the insurance company you bought the annuity through is bankrupt or liquidated. In that case, you may no longer receive the income you had counted on, which might leave you in an awful financial position come retirement time. Nevertheless, government and individual states often have life and health insurance guarantee associations that could help get relief if the insurer goes under. While annuities may sound like an easy solution to providing income in retirement, that annuity needs to pay premiums that accumulate to form the income. Annuities come with various fees, including surrender charges, insurance charges, investment management fees, rider fees and contract fees. In addition to the fee issue, an annuity may not provide the same returns you might be able to achieve investing elsewhere. You are giving up some of the potential upsides that you might otherwise earn for the security of having that future income. This could result in a smaller income in retirement than you could have generated by investing elsewhere, such as in a retirement account. Types of annuities. Types of annuities include immediate annuity, deferred annuity, annuity certain, guaranteed annuity, joint life, and last survivor annuity, and increasing annuity. Immediate annuity. An immediate annuity is the easiest type of annuity for most people to understand because it has fundamental provisions in its most common form. A typical fixed immediate annuity requires the annuitant to make a lump sum payment to an insurance company upfront in exchange for the right to receive payments, annuity, from the insurer regularly beginning immediately. The annuitant can opt for an immediate annuity to pay for the rest of his or her life for a fixed period or as long as another person elected as a beneficiary is still living. Deferred annuity. Unlike immediate annuities, deferred income annuities do not start making payments right away. In most other respects, though, they closely resemble immediate annuities. With a deferred income annuity, the annuitant pays a certain upfront premium. In exchange, the insurance company promises to pay a certain amount once the annuitant reaches the age specified in the annuity contract, for example, age 65 or 70. The deferred annuity accumulates money while the immediate annuity pays out. Deferred annuities can also be converted into immediate annuities when the owner wants to start collecting payments. Based on the above two types of annuities, that is, deferred and immediate, annuities can be categorized into two, fixed and variable annuities. Fixed annuity. A fixed annuity is an annuity whose value increases based on stated returns within the annuity contract. Typically, fixed annuities do not have payments begin right away and are therefore deferred annuities. However, unlike a deferred income annuity, it is flexible in terms of annuitants determining when to start receiving annuity payments from the insurer under the contract. Variable annuity. Unlike a fixed annuity, a variable annuity's returns are tied to a specific market. A variable annuity can be tied to the stock market, the bond market, a combination of the two, or a more specific investment niche or a broader set of investments. Specifically, Variable annuities often come with guarantees of minimum amounts of income, withdrawable cash, or death benefits that can give them an advantage over ordinary stocks and bonds. Annuity certain. An annuity certain is a contract that provides a fixed number of payments for a predetermined number of years, regardless of whether the annuitant survives. The policy will continue paying annuity to the annuitant or estate if the annuitant dies before the payment terms end. The payments are made regularly, monthly, quarterly, semi-annually, or annually. Guaranteed annuity or annuity guaranteed. A guaranteed annuity is an immediate annuity that guarantees annuity payment for a minimum period or until the annuitant dies, whichever comes later. For instance, an annuity guaranteed for 10 years will be payable for life or 10 years, whichever is the longer. If the annuitant dies during the guaranteed period, then the balance of the guaranteed installments will be payable to the estate. However, a commuted cash sum may be payable instead. Joint life and last survivor annuity. A joint life is an annuity that makes payments to both the annuitant and the spouse, or the annuitant and another beneficiary until both the annuitant and the spouse have died. A joint life with the last survivor annuity allows the annuitant to provide for the spouse continuingly, rather than giving a lump sum at death. The annuitant may also designate another party, such as an orphanage or a charity, to receive payments until the spouse's death. If funds remain at both spouses' deaths, the annuity pays a death benefit to the designated party or the survivor. Increasing annuity. An increasing annuity allows for installments to increase by a fixed percentage each year. This annuity assists annuitants to cushion the effect of inflation on the actual value of the payable annuity. An increasing annuity may be an annuity linked to the Retail Price Index or a unit-linked annuity. Retail Price Index, RPI, measure of inflation published monthly by the Office for National Statistics. It measures the change in the cost of a representative sample of retail goods and services. Categorization of annuities. Meanwhile, there are generally three main categories of annuities: fixed annuities, variable annuities, and indexed annuities. Based on our discussion of types of annuities, it is evident that each type of annuity can have variations. If you wish to purchase an annuity, make sure you understand the different types, associated fees, and how annuities work before choosing. Sometimes riders are available that can be attached to your annuity contract to give you extra options. It should, however, be noted that you will pay more premiums for a rider. Fixed annuities. A fixed annuity is relatively straightforward. Fixed annuities are forms of deferred annuity that pays a fixed rate of interest. The insurance company promises a set rate of fixed interest rather, not tied to market rates. There are two types of fixed annuities: immediate fixed income annuities and deferred income annuities. Immediate fixed income annuities usually require the annuitant to pay a lump sum to receive a guaranteed income stream for a set period, which could extend for life. Payments typically start immediately. An immediate annuity skips the accumulation phase and begins paying out an income immediately or within a year after being purchased with a single lump sum payment. Deferred income annuities are similar to immediate fixed income annuities. Deferred annuities allow the principal to increase before the annuitant begins to receive the stream of payments. The significant difference is that the income stream is deferred. Instead of beginning immediately, the income stream, i.e., annuity payment, can start after purchasing the annuity. This is commonly known as the accumulation period because the annuity is accumulating interest. The annuitant may be able to make extra payments during the deferral period to increase the future income. Variable annuities. Variable annuities are not as straightforward as fixed annuities. They are more of an investment product. Moreover, the annuitant must choose the desired investment options. The future income stream would depend on the number of payments and the return of the selected investments, and the administrative fees or expenses. While a variable annuity may give annuitants better returns and higher payout, but it results in a lower than anticipated income in retirement. Indexed annuities. Indexed annuities are somewhat of a mix between a fixed and variable annuity. With an indexed annuity, the annuitant can get a base amount of guaranteed income. However, another part of the income stream will depend on the performance of an index with possible investment growth. Essentially, indexed annuities can cushion the effect of inflation on the actual value of the annuity payments. Conclusion. What is an annuity, and how do annuities work have been discussed in this video. Annuities are insurance contracts that provide a fixed income stream for a person's lifetime or a specified period. An annuity can be purchased with a lump sum or a series of payments and begin paying out almost immediately or in the future. Buying an annuity can provide peace of mind by way of an additional retirement income. An annuity can provide a stream of income, in addition to pension and social security benefits, at retirement. I hope the video is educative and beneficial to you. We love to hear from you. Kindly post your comments below in the comments section. If this video has been educative and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comments section below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.